here with Kevin Amolsch. We're going to be talking about the market, what it's really happening about it. Kevin is into lending, properties, hard lending, and creating profit opportunities for his investors. We're going to learn more and how you can use it for your clients and what it takes to build an organization like he has. Welcome, Kevin.
Joe, thank you so much for having me on. I'm excited to be here.
Yeah, it's great to have you on. It's been a bit to try to get you here. I'm really looking forward to hearing what's going on in your world. So let's jump in. What is the biggest piece of what you're doing that we want to know about?
Yeah, so I'll take you back a little bit. I was a real estate investor first. I started way back over 20 years, over 22 years ago. Can you believe that? I was 21, I bought my first house, and 2 years later I bought another house, and I kept it as a rental, and I just saw how amazing real estate can be. When you have a tenant paying off your loan for you and you're getting cash flow and you're seeing the value go up, it's like becomes pretty obvious pretty quickly how great of a tool real estate is. And there's lots of different ways that you can make money and become wealthy in this business. I know you do a lot, Joe, with realtors and agents, and
Yeah,
and that's like a sales position, right? So
correct.
it's commission. So
Time
that's
for money.
sort of. I mean, there's no ceiling. So when I hear time
Yeah,
for money, that could be true, but usually I put a ceiling or a cap on that. Agents don't have to do that. They could really build systems and people around them
they can.
to eliminate that ceiling, right? So it's just a little bit different than a passive approach like a real estate investor might be after. It's more of an
Yeah,
active approach, but very high paying and probably a little bit more consistent. I went the investor route and I started buying one or two houses a month. I did that for years. And what I fell in love with, Joe, was the financing side. And the reason for that is the financing on a real estate transaction means everything. How are you going to negotiate the deal? How are you going to write the offer? What are you going to present? It all has to do with where the money is coming from. And I was doing a lot of creative strategies like bringing in partners and private capital or having the seller participate for equity or debt or those types of transactions. So it's just really attractive to me. So I became a mortgage broker, which was terrible, by the way. So sorry for any of you loan brokers out there. That's just a difficult business to be in. I just needed a little bit more control. I didn't want somebody else telling me yes or no they would do the deal, right? So I started raising private capital, and that was in 2006.
okay.
2008, as we sort of alluded to right before you hit record here, came and devastated the industry. And so I separated with my partner at that time and I started Pine Financial. So Pine Financial started in what statistically is the worst economy in housing ever. And here we are 17 years later.
That's fantastic. What a ride.
It's been fun.
Yeah, so
Not
let's
all
talk
fun
about
though,
that.
right? It's tough
Yeah.
sometimes. Yeah.
You know what? So you partnered with your partner. Tell me about that, how it felt, and like how that decision came around.
Yeah, that was a difficult one. I didn't make the decision.
Okay.
So she took me under her wing, and I call her my partner. It's just easier because we were building that company together. But it was her company, and I was working basically for her. I was a
Okay.
1099. And what ended up happening is we both had little portfolios. I had actually a much larger portfolio. I had 55 single family homes when the credit crash started to sink in. She had a handful. And look, it was tough. So we started defaulting on loans, and we started like trying to work with banks to do short sales and whatever the workouts were available to us back then. And it just took her down. She just got wore out, and she
Yeah.
decided she didn't want to be in real estate in the trenches. She would rather teach people how to do real estate very much safer. Nothing wrong with it. It's just
Right.
different, right? I would rather be in the trenches doing the transaction. So I chose that route. She chose the education route, and that's why we separated.
Okay. And then starting out in 2006 with brand new company, the 2008 hits, and I'm
Yeah.
sure you felt it coming before 2008. What was that like? How'd you
Oh
get through all
gosh.
that mentally?
Yeah. I tell you what, I did not see it coming, and I feel so embarrassed. Like here we are becoming vulnerable on your show here, Joe, because I was super embarrassed by this. I was actually for almost 18 months, or a little over 18 months, actually. I was a mortgage bond analyst for a company called Clayton. It was Murray Hill, and it went public, and the name changed to Clayton Financial. And what they did was they would take big Wall Street firms as clients, and they would analyze mortgage bonds. And everything we were underwriting and looking at was the subprime stuff. So I
Right.
was a prime mortgage bond analyst, finance degree, working on these every single day, and I did not see this coming.
Right.
So when it did start to sink in, here's what happened. It was 2007. Interest rates are going up because everybody was in adjustable rate loans back then. So as interest rates went up, all of our mortgages were going up, but rents were softening. So rents were coming down, rates were going up. That's really what created the start of the problem. And then as 2008 hit, then people started defaulting, right? And then you started seeing the banks collapse. So for me, it was like a very slow, painful process leading up to 2008. And then 2008 is really when I basically lost everything. I was a millionaire before I was 30, lost it all, and I had to build it back.
Wow, that's hurt. That's got hurt. So what did that feel like?
It was
What do you
terrible.
think?
I'll tell you what it does do is it tests your resolve, right? And if you can make it through a situation like that, this is probably good for your listener. If you can make it through, which you can, it's just mental strength. If you can make it through that kind of challenge, you will come out so much stronger, more educated, more confident on the other side. But it is going to take going through that. It's like basic training. I was in the army for a while, and the idea of basic training is to completely break you down. So when they get you in there, they shave your head and they start telling you how terrible you are and yelling at you and screaming and spits coming out of their mouth and then push-ups and until you can't do anything anymore. And then the process starts where they rebuild you. And then it's almost like you're a different person when you come out. Right. That's exactly what I went through financially. Well,
So
now I understand like what leverage is, how powerful it can be, how important it is to real estate investors. Agents are no different. I mean, your buyers typically are getting loans, right? So leverage is super important in real estate. So now I understand much better how to use it, how to stay safe with it. So yeah, I mean, I took a lot out of that time.
yeah, staying safe. We appreciate that as in the economy, doing the right thing. So tell me about how do you work? What are your funds like? How do you put your money to work?
Yeah, so it's been a long process here because it's been 17 years, but I started out just brokering private money. So I'd bring one private money investor with one real estate investor, and I'd bring them together and charge a little fee. What I learned, Joe, was investors, passive investors, don't necessarily want to put all their money into one real estate note. Real estate notes are the safest place to be in the capital stack. They get paid back first. So it's actually a rather safe and consistent investment, but there's still some exposure. If the borrower defaults or if there's a meth house or a foundation issue or something. So what I learned was I need to create some liquidity in these investments. I need to create a smaller investment amounts and I need to create some diversification. So in 2009, I started a mortgage fund. That was the first one that I started. And it solved those three issues. And so then I started bringing in private capital into the mortgage fund. And then that money goes out into real estate. So we're investing in Main Street, not Wall Street. We invest in fix and flip projects primarily. So if you're in one of the markets that we work in and you're looking for money for a fix and flip, that's where we come in. You see those TV shows, the Flipping Boston or all
Yeah,
of these different we're the money behind those types of transactions.
gotcha. Yeah. And so an investor, they have a piece of the whole, like a percentage of the entire fund, and that's how they get paid out. So they're not in any one given project. Is that how you were saying they
Exactly.
diversify? Okay.
Exactly. And we do have some defaults, and every once in a while we take losses. It's more common for us to do better if we get a property back. If there's a default, and we do a foreclosure. We end up making more money than it had the loan performed. But that's not always the case, right? Sometimes we will take a small loss. But here's the good thing about the way it's structured. Our investors don't take the loss. Right? In fact, we've never taken a loss for an investor, and we've never missed our preferred rate of return. So every single month, we've paid on time for 17 years.
And now so you as the firm absorb the loss,
Yeah, well, the fund does. So
the
it's like
fund.
insurance. Think about insurance. So if everyone's paying into the program, right? And then there's a hurricane that comes through, right? So they're taking losses in that one specific thing. But all the
Right.
premiums come in, absorb that, right? So us as a
Yeah.
group, a collective group
Okay.
absorb it.
Okay. And the investors never felt that. That's pretty
Exactly.
strong. Where are you lending?
I'm in Denver, so I'm calling you from Lakewood, Colorado, just west of Denver. So we loan up and down the Front Range here. Our next primary market is Minnesota, but it's just we stick right in the Twin Cities. So up and down the Front Range, Colorado, and the Twin Cities. Those are two primary. We do some business in Wisconsin also. We're doing a handful a month or so in Milwaukee. And then we're really picking up some traction out in DC, so not far from you. But
Okay.
yeah, we're doing some business in DC as well.
And how are you choosing these markets?
Yeah, it's a fun story behind everyone. Colorado's obvious. I'm a native of Colorado. I grew up here. Minnesota. So my former wife grew up in Minnesota. So we had a pretty strong network there. And one of her brother-in-laws was in construction and banking. So it was like the perfect match for what we do. He could go out and do my inspections for me and someone I trusted. So I know that we're keeping our assets safe. And then it just blossomed from there. Milwaukee or Wisconsin's right across the border from the Twin Cities, but up in Milwaukee, we had an investor go up there and start doing a pretty high volume. And so we followed
Okay.
him up there. And then in DC, we had a hedge fund courting us. So it was like years they were calling me. I want to go to DC, but I want to use your systems. So we took hedge fund money and put it in DC. Since then, they've moved on to other things, but because we had the market already established, now we're investing our money there.
Nice.
Yeah, yeah. So each
Wow.
one's a little because I get that question all the time, Joe. Like, what? Why Minnesota? Like, it's so random. Yeah, it is random if you're looking at it from the outside, but there's a strategic reason for each one of them.
And does that help? You talk about diversification. You're in multiple markets. Every market's local and gets affected by the economic winds in different ways. So that
Right.
it in itself is some diversification, which is great.
Exactly right.
The types of products. What are you looking at?
Yeah, our focus really is the fix and flip, but
Okay.
well, I'll say residential rehab. Let me say it that way, Joe, because here's what I'm seeing and what I've seen over the years people do. Because we're such a high leverage lender, private money it's more flexible, right? We don't have to stay in that little box that a bank will keep you in. We have flexibility. So we can go higher loan to values. A lot of our loans are 90 to 100% loan to value or loan to cost. So our borrowers are not bringing very much money to the table. So if you can keep money in your pocket instead of putting it into the deal, it really opens up options for you. So what we've seen is investors go in and buy a property, fix it up with our money, put a tenant in it, start generating cash flow, and then refinance it into a Fannie Mae loan, a 30-year fixed. That's the cheapest money you can get. And then pay us back and then go do it again. But if you have very limited or no money out of your pocket into the deal, it doesn't really put a cap on how many you could do, right? You have caps with Fannie and Freddie, but it does really open up the volume you could do.
Investor, and how do you vet the property?
Yeah, so we do look at both. Not all private money lenders or non-bank lenders like me will do that, but we do want to qualify the borrower and the project. So let me start with the borrower first. The biggest thing that I've seen, the biggest reason people get into trouble in any real estate transaction, whether you're a fix and flipper or a landlord or whatever, is lack of liquidity. Look, if you have money in the bank and you have reserves, you could fix problems. It's the second that money is gone and you can't put into a project, you can't feed it if it needs fed. That's when your house of cards falls. So we qualify, make sure that there's enough liquidity. So I said to you, we don't necessarily need down payments, which is true, but that doesn't mean you shouldn't have any money. We do want to make sure that you have some reserves. Yeah, okay. We look at credit, although credit and income is less important to us. It's really the reserves and either experience or a team around you with experience. Now, in the asset itself, we run it through a profitability calculation. So we have a calculator that we use. It's pretty simple math, but we want to make sure that you have certain margins or certain profitability thresholds, and then we'll do it. Now, in a place like DC, where it's definitely softening, we're going to stress test this. So we want to take your value, knock off 10%, and then run it through the profitability calculation. And if it's still profitable, then we're interested.
Great. Nice. Smart. Tell us about how real estate agents can utilize your services and make it work for their business.
Yeah, and whether it's me or any other non-bank financing, this is definitely a tool that should be in the tool belt. I often joke like you don't pull out your hammer when you have a screw in your hand, right? You need the correct tool to make that work. And hard money or private money isn't a tool for every transaction, right? It's a very niche product and it's very specific situations. So for the realtor that's listening, we're looking for properties that need rehab. If it's a property that needs work, habitability is the term used in the industry. If it's not a habitable property, it gets very difficult to finance. Like banks don't want it, right? And then if you look at like community or commercial banks, they don't want anything that doesn't cash flow. They're not going to invest in fix and flip projects because there's zero cash flow until you sell it, right? There's no income. So banks don't like that. So if you're getting hung up on, non-bankable transactions, whether the down payment's not sufficient, whether it's the property needs rehab or something like that, or income documentation maybe, but there is an exit, like you're going to flip the house or you got a refinance lined up. They just want to see the cash flow, something like that. That's when you would bring in someone like me.
Gotcha. Are you open to other markets if you had a strong player in a certain market approach you?
Potentially. Usually we want to establish a relationship first, and we will sprinkle some cash across the nation following clients. If we have a really good clients and a really good guarantee on that loan, that's more comfortable to me. But I don't know if I want to do like a $200,000 or $300,000 loan in some random city that I haven't ever done business, because even though the borrower is good, if I don't know them well and something goes wrong, then all of a sudden I have this one little tiny problem and it's just absorbs my time, right? So we're just much better staying focused geographically.
That's right. That's what we want. What else is important for us to know?
So I think you said right before you hit record here that you're
Yeah.
really trying to help realtors and real estate agents, and it sounds like maybe they're newer to the industry. We didn't really get into a lot of detail there, but it sounds like maybe it's in the first couple of years of getting the business going. And you were asking me like, what can agents do to really make sure that they're successful in this business? I interviewed somebody on my podcast just this week, and they were talking about commercial real estate. And the eight commercial real estate agents, the turnover in some firms is over 90%. That's ridiculous. And I
That's
know that residential is not far off from that, right? It's just a tough business. It's very easy. The barrier of entry is very low, right? It's easy to go get the license, but what's hard is to actually get the business. So for newer real estate agents, I would be hyper focused on building out your business, your inflow of leads. You're going to find that most of those are going to come from referrals. Now, repeats and referrals, so R&R, not rest and relaxation, it's repeats and referrals. That's what you're going for. Right? That's where the residual comes in. So it's a relationship business. I know agents are really starting to use AI and implement AI. And one of the best ways they're doing that, Joe, is just to role play with the machine. Like if I'm going to go into a house, a listing appointment, and here's how I'm going to present it, what's some possible questions, and how should I respond? And then start practicing these meetings, these listing or buyer meetings, and then you could get better and better because that's where you make your money is the
yeah.
building the relationship. So I would be hyper focused if I was newer on building out my CRM, my network, and adding value to that.
That's great. That's great advice. So what are you seeing? I typically like to keep the show evergreen, yet you put together reports on the market, and I'd love to hear what you're seeing, what you're thinking right now.
Yeah, and I know you said this isn't going to go out for 5 weeks, so things are going to change even in that amount of time. But I'll tell you this: I get questions all the time, and even you said it before you hit record. You have a little bit of anxiety about 2008 and what we experienced, and for good reason, because that was a very challenging time. That wiped out a tremendous amount of wealth out of the country, right? We know what happened there. The values of the real estate had come so far
Yeah.
down. So what are we seeing now? And it is this problem that we saw 17 years ago possible to reoccur? Like, can we see this again? Of course, my answer to that is yes, but I don't think we're going to, at least not in this cycle. And there's many reasons for that. Two of them I'll just give you is that we're at almost record level equity, and equity creates options. So why would someone go allow their house to get foreclosed on if they have equity and they could just drop the price and get rid of it, right? So that equity creates a little bit of a cushion. We also have pretty high mortgage rates if you look at the last 50 years, or not 50, maybe the last 20 or 30 years. The mortgage rates are pretty high. If you go back 50, now we're catching into the 80s, right? And then all of a sudden you're
Yeah.
like, well, that 18%. So now it looks pretty low. But over the last 20 or 30 years, they are a little high. And so, although I think that those are normal rates, there is room to lower those rates, right? So if you start seeing a problem in the economy, we're watching jobs closely, right? And the unemployment rate is not moving; it's very sticky. If you saw that start to rise, then you would see the Fed react, right? And they would lower rates, which over time would eventually catch up to mortgage rates. And then you would start to see those drops. So I think that would create sort of a floor. So we're not going to see a big tank in values. It is important now that I'm saying that mortgage rates and the federal funds rate, they're not the same. And although
No, a lot of
they
people
are
get mixed up
correlated,
on that.
yeah,
Yeah.
exactly. There is some correlation there, but you'd have to look at a longer time frame to see that correlation. It's very common for short-term rates to go down, so the Fed to adjust rates, and mortgage rates to go up that same day or the next day. That's very
Yeah,
common
we've seen that recently.
just recently, right? So I just want to make sure that people understand that even if the Fed says, okay, now we're ready for a rate cut, we're hearing it might be September. Don't think that mortgage rates are going to go down immediately. In fact, I think it might be. I don't think you're going to see a mortgage rate start with a 5, a 30-year fix start with a 5 until the end of 2026, maybe even past that. Do not think, guys, that you're going to get saved by lower mortgage rates. There's mortgage rate acceptance right now. That's not the problem. We still have to go out there and do our business.
Yeah, has the sevens and the sixes, is that now normalized? And are we still, seems like we're still fighting the fake numbers from 2020,
Yeah.
21.
Yeah. I think there's market acceptance now. And the reason I say that is mortgage applications have been going up. Purchase mortgage applications are going up. And that's the leading indicator for demand, for purchase demand.
Yeah.
So
Yeah.
we are seeing it go up. But what I was going to mention to you, Joe, is if you do want to study history and different recessions and how it impacts real estate, you will find that most recessions don't impact real estate really hardly at all. If they do, it actually increases the value. COVID may be an anomaly, but that was a good example. That was an official recession, and we saw values go up like double digits for a couple of years, right? So there's each recession is going to impact the housing market differently. But if you go all the way back to 1990, that recession hit real estate values pretty significantly. It was about 14% decline in values, which is significant.
Yeah.
And the reason that happened is the high inflation and the high interest rates coming out of the 80s. So that's a little bit more similar to what we're experiencing now than the 2008 crash. So I just wrote a report and I compared those two times so that we could try to understand what's possibly coming. And we give that report away for free. Yeah.
Where do we get that?
It's thepinereport.com. So just thepinereport.com.
Thepinereport.com. I'm going to check that out. We purchased our first home in 1989. So I'm well aware of the 90, 91, all that stuff that went on then. And obviously in the business in 2008 and obviously still. So that'll be Pine Report was very.
Yeah, let me know. Shoot me an email, Joe, after you read that and let me know what you think.
Yeah, definitely going to be looking at it. So anything else you want to share before I ask the final question or so?
I don't think so. I think this is a fantastic business. If you're a real estate agent, you're exchanging transactions for money and living off that. I think that's a great way to make a living. I would also just encourage maybe try to create some passive income also.
Yeah.
This is a problem I see with agents a lot. They just get so good at transactions and making all this money, and then they don't really do much with that. So maybe every once in a while, just do a transaction on your own that you keep. So that would be one thing that would be pretty life-changing, I would think.
And speaking of true passive investing with your fund, are there minimums or how does that work? How do you vet out your investors?
Yeah, good question. So we have two funds that are available, one for accredited investors only and one that is able to accept non-accredited investors. That non-accredited investor, that one's a little bit tougher to manage because there's a lot of scrutiny around it. Twice a year reporting, it's all SEC approved, all of these things, right? So it's a little bit tougher, that one. But the good thing by us going through that pain is now we can offer it to everybody. And it's only a $10,000 minimum investment. Nice. So really low threshold. What we're trying to accomplish is people want to get into the real estate debt space. They want some exposure to real estate debt and just to create a little consistency in their portfolio. We want to open that up to as many people as we can. So that's a $10,000 and it's an 8% promised return. So there's a promissory note and it just comes in every single month. And there's no lockup period. So you can get your money out anytime. The other one is $100,000 minimum, and it's an 8 preferred with some upside. So you'll make a little bit more money on that one. But again, you got to be accredited.
Yeah. Good. That's 10,000 that opens up the door for a lot of people.
Yeah.
That's fantastic. Cool.
Yep.
All right. So knowing what you know now, you've been through quite a bit over the last 20 plus years. What would you tell yourself, your old self, when you get spit in the face by your commanding officer? What would you tell him that you know now and what he was thinking back then?
Yeah, you know what? That's an interesting question. I've never been asked it quite like that. So this has got me thinking. Usually you come on these podcasts and you get a lot of the same questions and you have your little canned answers. And I had one ready for you, Joe, but the way you made me think a little bit differently here. So something I learned early on to get through some of that pain is to just convince yourself it's temporary, which it is temporary. Everything is temporary. It will end. So as you're going through it, it freaking hurts. I'm telling you, and then you're not sleeping at night, right? And you're not taking care of yourself. Driving a car is dangerous because you're not focused on what you're doing. And so you might find yourself not paying attention. So there's a lot to it when you're going through a situation like that. And I'm not talking about the spitting in the face like you were saying. I was saying going through a tough time in business. But the advice I would give myself is, man, just stay in it, because if you could sit in that and live in that, it will go away and you're going to be better on the other side. So it sucks. It does suck, and it's going to end.
So in the middle of all that, I 100% agree with all that. The good times end too, right? Everything's
100%.
Everything's cyclical. Everything's cyclical. So when you're in that dark, you're not sleeping, you're just grinding, and you can't, your brain can't stop. How do you keep that positive beacon in front of you that you're doing the right thing?
Yeah. There's two things here. One is affirmations. I'm a big believer in affirmations. So if you haven't read The Secret or any of those books about this manifestation, the power of attraction, law of attraction, those types of things, I'm a big believer in that. And I think that's sort of what got me through some of my tougher times. But I will use that exercise. I will do affirmations, and then even in the good times, I will do that. So I think that's huge. You could think of that as like sort of meditating also. If you're more into, instead of repeating something to yourself over and over, you'd rather just sit in a meditation. Guided meditations are fantastic also. But I'll
Yeah.
tell you one thing, that the way I react when I'm getting challenged, like massive action solves all problems. I believe that in business anyway.
Yeah.
So if I'm struggling financially and I'm not sure how I'm going to pay my credit card bill, I might wake up the next morning and make instead of 50 calls that day, I make 100 calls that day. And then it's just going to be a tremendous, like a noticeable difference in the action I am taking towards my success.
Perfect. Fantastic. Kevin, thanks so much for coming on the show. Viewers, check out thepinereport.com, right?
Thepinereport.com. Yeah. And if you're interested in private,
Pinefinancialgroup.com.
like passive investing in real estate, you just go to pinefinancialgroup.com and you can get all the information about the company and what we're doing there.
Excellent. I love that your threshold's low for people to get involved. So pick up the phone or get in touch with Kevin. And one of the things too, Kevin, is as real estate professionals, well, we should be more advisors, and as a financial advisor would be, and bring these types of opportunities to our clients. If they want to get into real estate investment, we should be sharing what we know about your types of service, what you're doing, so they can leverage their money as well.
I agree.
Thanks so much.
Yep. Thanks,
Be
Joe. I
best.
really
Have
appreciate it.
fun.
Had a great time. Thanks.